What's going on, guys? My name is Klutch with Oracle Investing, and with me today I have Doc.
How's it going?
And today we're going to be going over supply and demand with you guys. Yeah, it's a tool that we use to kind of help us identify turning points in the market and give us really a sense of a really good risk-reward setup that we can take advantage in any given market. One key thing to go over is that you can use this in any time frame, any market, and it works all over. Just to kind of break down for you guys what exactly is supply and demand is our goal for you guys today, and how we are able to identify and draw these levels that give us our edge in the market. But before we go into that, we're going to kind of give you guys a little insight of why these levels are important to us and why we use these to identify our risk and reward setups. So the market is broken down into two categories. You have institutional trading and you have retail trading. Versus what you guys might actually think, it is not retail traders that move the market, it is institutions. And institutions can come in many forms. It can come in the forms of hedge funds, big banks, federal market pumping liquidity into the market, which is what we've been seeing lately. And those are the guys that are really in control of the market and really moving price. So institutional traders have a incredible edge over retail traders. They actually are able to see real willing buyers and sellers in the market, whereas retail traders, we see orders that have already happened. So we are seeing orders as they are happening, not as the orders are being put in. And there is a big difference. And we're going to go into that with you guys today. So 90% of retail traders fail. It's a statistic, it's just a fact. And it's just because these institutions will pry on human emotion. And we're able to see examples of that with supply and demand. And as far as the, give me a sec. Yeah. So institutions are going to pry on human emotion. It's how they make the majority of their money, and it's how they actually trick you to falling right into their plan. And we have a few examples of that right up here. As far as supply, it's supply is sellers are exceeding buyers. So up here, we have a prime example of that. We have a huge rally in price. We have a little bit of stall, and then we have a giant flush of imbalance. And what I mean by imbalances, it's what we just talked about. Here we have sellers are exceeding buyers in the market. And this is exactly why this level has been mapped out for us, is that this is a weekly supply level for us. This is where we see a huge flush. This is telling us that there are still orders sitting up here to be sold. A key way to identify that is a large move away from this level. If you see orders that are moving, or if you see price action that's moving away too quickly from a level, you may have been on the other side of that, waiting to get in on your sell order here and had to chase to get out. Believe it or not, big banks and institutions, they don't chase price. They will wait. So what I mean by that is, instead of them not getting their orders sold up here, they aren't going to chase and sell on a chase down. They're actually going to wait and force price action to come back up to them so that they can then again get a second shot at reselling their orders. Demand is the exact opposite side of that. Demand is where buyers are exceeding sellers. And we have a prime example of that right here. So we have a drop-based rally price action going on here. And again, here you can see that price didn't hang out here too long before we had a huge influx of buyers pushing the market back up. And one thing to note here is that this is a weekly time frame. So each one of these candles represents a week's worth of price action. So these institutions had about a week to accumulate their orders before they sent it off upwards to the market to then again sell their orders. So up here, you're going to see that we have weekly and weekly. We have a demand and a supply. So these are our two big levels. These are our big turning points in the market. And as you can see on Netflix, price does a pretty good job of bouncing back and forth between these levels. And this is where we are identifying our risk and reward setup to take advantage of these price swings in the market. And just to kind of give you guys a little tidbit of, I guess, what supply and demand is, you would never go into a grocery store and offer to pay more for bananas. You just wouldn't. So why would you do it in the market? Our job in the market is to get the best possible deal we can and sell it at the highest price we possibly can. So it doesn't make sense for us to be chasing levels. It doesn't make sense for us to be forcing trades. The best thing about supply and demand is that it's going to teach you a lot of patience, and it's going to teach you guys to get the best bang for your buck in the market. So we're going to go into this a little bit. So here, this gray line, you can imagine this as the market's biggest orders waiting to be filled. So what we're going to do here is we're going to draw this imaginary price line over here. And here, we're going to look at this as our buy and sell volume over here, but as hidden orders. So up here, you can see that we have some sell orders. We got this big bar just waiting for sell orders that are in limit orders to be sold up here. So we're going to kind of draw this picture for you guys. You're going to see the orders get smaller and smaller just because the supply level is weaker through here, and it gets stronger as you go up. Kind of makes sense. So down here, we're actually going to draw the market's real willing buyers. And we're going to get to this big level all the way down here. So if you kind of imagine and flip the volume chart over here as hidden orders, orders you're not seeing, that's all of the blank space that we're going to be seeing, all this black chart area or white, depending on how you have your chart set up. View this as invisible orders. And if you flip your chart and you kind of start seeing the market like this is big banks and institutions' real willing sell orders. So up here, we're going to have our biggest sell volume, and all the way down here, we're going to have our biggest buy volume. And our job is to help you guys navigate this market to stay ahead of the edge of institutions and basically people that have enough bank to move the market. And how we do that and how we're able to map and identify these are these simple candle structure setups that we're going to go over with you guys for right now. So here bear with me for 1 second. So here is how, Doc and I are able to make the majority of our money in the market by following these simple levels right here. And just bear with me for 1 second. Okay, so here are our 4 levels and 4 price actions that we're able to identify and draw imbalances in the market. So here you're going to see a rally base rally setup. So here you see price, we have a rally in price action moving away from an imbalance. And here you're going to see a pause. And this pause is the real market's willing demand, the real willing buyers in the market. But then you're going to see that price moves away too quickly. And here you're going to notify that this is an imbalance level. That basically here they were pausing to accumulate in a rally setup, so a bullish trend, that they were trying to have an attempt to fill orders, but didn't succeed because price just moved too quickly away. And we'll go over that in just a second, but just so you see the other examples before we go on. Here we have the inverse. Here we have a bearish setup, a bearish decline in price. So you're going to see a drop in these candles. You're going to see a base where they are attempting to, fulfill even more sell orders during a downturn before price exceeds, before sellers exceed buyers again, pushing it down, creating a supply level here. And then next we have a rally-based drop setup. Price is going to be rallying before we plateau for a little bit, and we see price stall before actually turning in the market and having sellers exceed buyers again, causing a drop in price. And finally, what we have here is a drop-based rally setup. Sellers are exceeding buyers again, before we have a pause and agreement where buyers are attempting to accumulate shares before the next move up, causing a rally in price. And essentially, how we are going to draw these levels here is going to be incredibly simple. Um, so, when we are drawing a demand zone, we're actually going to be starting at the opening of this candle, which is going to be right here. And we're going to be drawing our box, if you will, all the way down to the bottom of the wick. That's just where I like to get the whole movement. So instead of just keeping it within the body, we're going to get the wick in there because that is where price ultimately went and stopped before we had a turning point. And one key thing to note is imagine if you had a sell off through here, and this is where we'd be trying to catch our move, is we're trying to catch price within this box. What's going to invalidate this is if we have 100% retracement through this box, breaking through the level here, which would be your stop. And the same thing is going to apply to each of these levels that we're going to go over as well. So a demand box, again, will start at the opening of the candle and go all the way down to the base. For supply, it's the inverse. We're going to start again at the opening of the candle, but we're going to draw the box, capturing the top of the wick. That will be our 100% level again. So if we see that price, if we see a rally in price breaking into this rectangle, we're waiting to see how price really reacts to this level. If it's truly respecting the supply level, your ultimate stop would be a break of this level. This 100% level, if we had a break in price breaking through, that would invalidate your short setup and ultimately be your stop. The same thing is going to apply for this rally-based drop setup. Again, it's a supply setup, so we're going to be drawing from the opening all the way to the wick and completing our rectangle this way. Again, same thing for the drop base rally. We'll start with the opening and draw through the bottom of the wick. So this is exactly how I identify my levels and draw them. These are my turning points in the market. And it's with these 4 simple setups right here. So again, just to go over, a rally-based rally is a bullish setup. Sorry, I want to get my pointer out here for you guys. So this is a bullish setup. We have a rally-based rally, a pause, creating a nice, beautiful demand level. We have our bear setup, a drop-based drop setup, where we are dropping through before we have a pause in price action, before we continue creating our supply level here. And then again, a rally-based drop, which is ultimately causing a surge in price, trapping bulls and making them think that we are going to be breaking higher, where this is actually a turning point before sellers start to turn back. Again, the inverse, a bullish setup where we have a drop before our base, before our rally taking off. And the key thing to note, you guys, is we aren't trying to predict these moves. We aren't trying to capture this move as it's happening, and we aren't trying to catch the falling knife while this move is happening. And we're going to show you exactly what we mean by we allow these moves to happen. We aren't trying to capture them in the moment. We're actually trying to catch them on the flip side. And Netflix does a pretty darn good job of giving you guys that example here. So here we have I know it's a bit exaggerated, but here we have a rally base drop setup here. So here you see that we have a huge rally in price where buyers are exceeding sellers, squeezing them all the way up to where we finally plateau and have our drop. We'll get to this pivot here in just a second, but just to paint the picture of a rally base drop setup into a drop base rally setup. So here, as you see, here you could have caught this move given what time frame that you may have been. Here we are in a weekly setup, so we are looking at weekly candles. In here, I believe, as I was annotating this, there was a daily demand level here, which could have started here and ended here, which could have given you a nice risk reward to capture this move right here. But I drew my level here. So here, we aren't trying to catch this move as it's happening. We're actually waiting for price to come back down to retest this level to show us what type of strength that we have here. And as you see, we just had a quick wick move away from the level before price surged away from it. So this would have, you would have been waiting. You would have probably set, a price alert right around here at this 275 level for you guys to not be watching this tick by tick. Typically, when I draw my levels, I'll set an alert and just wait for the alert to trigger, and that's when I start paying attention to it again. So I don't make any bad impulse decisions and just start trying to chase price, trying to stay ahead of it. Instead, I'll set my alert right here, nice and ready, giving myself a 25-point move to hit this level. And here you see it respected this incredibly well. This would have been a great risk reward setup for you. Here we would have zoomed in on this weekly time frame and then tried to identify maybe a daily, a 4-hour, an hourly, or maybe even a 30-minute level in here, which we could have captured a even better risk reward setup. And that's something that we're going to go over in a couple later videos for you guys. But here I just want to get you guys to have the basic understanding. So we're allowing this move to happen. We aren't trying to catch it. Up here, we have a daily rally-based rally setup, which is a bearish setup. So here it kind of gave you the opportunity to catch it on the flip side for a short. And we can get into, give me one second. And here we could have gotten to this move. So this is, again, something we're going to go over in later videos for you guys, the importance of time frames and how they work in confluence with each other. Oh. All right. Give me one second. All right, here we go. So up here, we're going to see our rally in price, our base, and our huge drop. So the thing to note here, guys, is I'm sure you're seeing all this chop and probably wondering, well, aren't these levels, aren't these rally-based rally or drop-based drop setups? And yes, they are. You can see here, clearly we have a drop in price, a base, and a rally. Same story here. And you can see how price is reacting to these levels relatively well. Here we had a great drop. You could have got this. But I didn't want to muddy the chart and have all of these all over the place. So we'll keep it short and simple for you guys, just so that we're able to stick to the point and help draw the best picture possible. So here's our daily rally-based drop setup. And you can see once we had this movement, we dropped all the way down to our weekly drop base imbalance. And here, we mentioned the importance of time frames. So we're here on the daily. We'll go ahead and delete this just so you guys can see more clearly what I'm about to do. Is that I know that's my weekly level. This is a big weekly imbalance level. But just at the tip of that level, I had my daily rally-based rally setup inside of that weekly, which is where our ultimate drop actually caught itself before our turning point in where buyers were exceeding sellers, pushing the price up. So if you were to look back and you would see that this weekly level actually captures this whole move right in here. We like to see, again, what's inside of it. Oops, sorry, I don't know what happened. Oh gosh, not as pretty as a picture, huh? So here we'll have, a much smaller time frame compared to the weekly of where we could have estimated where a turning point could have been before hitting our weekly zone. Here, the reason why we do this is just we have a much smaller risk reward setup. Here it's starting at 25.58, giving you a $8 risk for what ultimately could have been. Gosh, my chart's just not cooperating with me today. Yeah, just bear with me, guys. Not as techy as I seem. But this $8 risk yielded we can even say from the bottom, 250, all the way up to a 381 level. It's a huge move for a $8 risk. So this is just a prime example of the power of supply and demand. And the picture I want to paint for you guys is that within these levels, we're going to imagine all of these unfilled orders just waiting here. So we're just going to get these little arrows ready. So here, imagine we have all of these sell orders. These are big banks, institutions, just piling on the sell orders, waiting for these orders to happen. And the idea is, we'll do it actually here because we tested it. We have all these willing demand orders just selling here. Buyers are just waiting to get filled in these zones. And the beautiful thing is when you have competition in a market, there are people who are trying to get even ahead of said other bankers and institutions. And this is a big importance for you guys when we have a level that's been tested once. You can imagine that once we tested this, a few of these guys kind of went away. This first line of buyers, they could have been bought out right here, even on this little dip. So this is a fresh level getting tested once and having price move away from it. And as you can see, price moved away really quick. So here we can estimate that we still have some buyers that are sitting here. So when price finally comes back down and tests this level, you can imagine that it's going to wipe away again some of these buy orders. So the importance of a fresh level, what I mean by fresh is this weekly level up here is completely fresh. We haven't tested it, not once. We've come really close. Here we inched our way to it, which again leads to my point of competition. You can imagine here that price hasn't hit here for a bit. So maybe some banks, some other hedge funds, maybe even feds are just waiting here. And they haven't gotten their fills yet, but they got close. They see that we have this daily supply level kicking in here. So if I was them, I might want to get a little bit more ahead. So put orders outside of the zone, just barely, so that we start testing these daily levels. A little bit of these guys start disappearing little by little because they're moving their orders further down. But this is a fresh, untested level. You can see the power of this when we had this drop right here, that a fresh level, the longer it sits there, the longer people are going to get a little bit more impatient, and typically the longer that they're going to be starting to move their orders a little bit ahead of the biggest level. So the biggest point I'm trying to drive home for you guys is that institutions, they run the market, and supply and demand is a good way of helping us identify the best possible turning points that can take place in the market. It's retail traders against the big guys, and for us this is going to be our edge. This is the edge that I use within the market on any given date or any given time frame, any given market. It could be options, it could be commons, it could be forex, you name it, cryptocurrency even. This is a great way of identifying key levels where the market you can see turn. And we have a prime example of that here, prime example of that here. And essentially how we draw those levels was further back in the video with the rally base rally, the drop base rally, all of those guys. And we're going to have a couple more videos for you guys, but I definitely wanted to get your feet wet and kind of get a grasp of the concept of what supply and demand is and why we use it. And it's essentially to help us, I guess the word I'm looking for is stay not ahead of the big banks and institutions, but thinking like one. I'm sure you guys have read books and you've seen a ton of videos where they're telling you to be buying on a rally, that this is showing you that you have, that you want to be going with the flow of the market. But that's actually not true. This is where you actually get screwed over a lot of the time. Had you been thinking that this is a resistance level and you're trying to bet that we're going to break through this resistance level right here, taking a short position, I'm taking a buy position, you would have inevitably gotten burned, especially if you were waiting patiently and you wanted to give it more time, or having another test up here. I mean, look what happened. We had a huge sell-off. So I don't really follow supports and resistances. I really try to follow the theory that we're going over with you guys today, because it is proven time and time again how valuable this concept is. And the ironic thing is that they don't teach you this in textbooks. They don't teach you this in, trading 101 or whatever have you. It's actually the exact opposite. And that's because we want to get you guys thinking like a bank. we want to drop that retail trading mentality because ultimately, why would you be trading why would you be trading with a retail trader's mindset if 90% of them fail? Personally, I would like to be thinking as a big bank where 90% of them succeed. It's very rarely that you see a big bank or institution fail. Look at people like Morgan Stanley, Wells Fargo, Bank of America, all those big guys. They've stayed profitable for years in the market, and it's because they all follow each other. They identify the turning points in the market before we even know they're happening. So if it was me and I'm a trader, I would be trying to think more of like a big bank and an institution rather than a retail trader. And how we do that is by mapping these levels. We want to stay ahead with them. We don't want to be getting FOMO and trying to slap up a price up into a supply level just to get burned and get sunken into a demand. Um, Trading books tell you to buy in supply levels and sell in demand levels, which is just such a silly concept. But this is ultimately where I get my edge in the market and where we're able to identify those key turning points in the market. And again, this is a part one video out of two. So we will be putting out another video for you guys. And it's more going to be along the lines of, fresh levels, how we're able to identify them, how we're able to identify a not so fresh level. I know we kind of touched a base on it a little bit, but just to go more in depth with you guys. Doc, did you have anything you wanted to splash in on?
No, I think you covered generically. I think we have more questions coming up while we're drawing the supply and demand levels next time in our next
Oh,
video.
sure.
And just to essentially identify, this is a really good video just to kind of figure out, get your mind set properly. Because anybody can learn how to draw these supply and demand lines, but to truly figure out how to draw good supply and demand lines and to identify the good ones, you really need to kind of understand exactly what they are and what they represent. And this is a very good intro to get into that.
Perfect. Certainly posting this video, guys, today. It is Saturday, April 11th. Really soak in this information. I'm expecting questions from you guys. So please feel free to DM Doc and I, even post it in the alpha chat maybe. If you guys have questions, just so that we can help answer them and just to help make sure that you guys are truly understanding that we're doing this correctly. And yeah, that's kind of all I have for you guys today. Doc, did you have any
That was
last
it.
words, or that was it? Perfect.
We'll see you
All right,
guys
you
next time.
guys. Yeah, exactly. Enjoy the rest of your day, you guys.